In the gleaming automotive showrooms of 2025, electric vehicles command prime display space, bathed in carefully calibrated lighting that accentuates their sleek profiles and innovative features. Corporate press releases trumpet billion-dollar investments in electrification, and CEO keynotes feature promises of carbon neutrality timelines, growing ever more aggressive. Yet behind this public facade of electric enthusiasm lies a more complex reality, one where certain automotive executives privately harbor doubts, hesitations, and even hopes for electric vehicle adoption to encounter significant headwinds. This isn't the simple tale of Luddite resistance that EV enthusiasts might imagine, but rather a nuanced story of genuine business dilemmas facing an industry in unprecedented transition. The financial mathematics of EV production presents the most immediate challenge driving this private skepticism. Despite years of promised cost reductions, the harsh reality, as Stellantis executive Jeff Hines acknowledged in February, remains $15,000 to $20,000 in additional costs compared to a standard ICE vehicle. For publicly traded companies under relentless pressure to deliver quarterly profits, these economics create an uncomfortable equation. Many established manufacturers are actively taking a loss on EVs to maintain market presence and regulatory compliance, while privately hoping these losses remain temporary rather than structural. Wall Street's recent punishment of automakers, prioritizing aggressive EV strategies, has reinforced this financial anxiety, with Ford's stock price surging 12% last month after announcing scaled-back electric ambitions. The January 2025 sales figures tell a complicated story that fuels this private ambivalence. While global EV sales jumped 18% year-over-year with 1.3 million units sold worldwide, this growth masks significant regional variations and surprising consumer shifts. The American market maintained a steady 22% growth to 130,000 units, but industry analyst Ed Kim from Auto Pacific has revised his annual EV market share projection downward to just 9.7%, acknowledging that EV adoption will grow but at a much slower rate than previously anticipated. This reality creates a tension between public proclamations of an all-electric future and private financial incentives to maintain profitable combustion vehicle sales during what could be a protracted transition period. The hybrid revival has particularly complicated this landscape, with families seeking a compromise between eco-consciousness and practicality. General Motors, once the loudest voice promoting an all-electric future, with its high-profile all-in EV campaigns, has quietly pivoted to rely on hybrid sales in North America, a tactical adjustment that speaks volumes about the gap between public positioning and private market assessment. Toyota, long criticized for its hybrid-focused strategy, now finds itself vindicated as consumer preferences align with its more gradual approach to full electrification. This market signal reinforces private hopes among some executives that the transition might unfold more gradually than regulatory timelines demand. For traditional automakers, the ghost of sunk costs haunts every electrification strategy session. Unlike Tesla and BYD, which built their businesses around electric propulsion from inception, established manufacturers face billions in existing investments in ICE technology potentially becoming stranded assets. Assembly plants in Michigan, Tennessee, and Alabama represent not just buildings and equipment, but generations of manufacturing expertise centered around engines and transmissions that electric vehicles simply don't require. The psychological and economic weight of potentially writing off these investments creates a powerful incentive to hope for a slower transition schedule that would allow greater return on existing combustion-related investments. Technical limitations of current EV technology continue to provide legitimate reasons for private skepticism. Range anxiety remains significant in 2025, with commercial applications particularly challenging. As Hines noted in a March business forum, with the technology, certain people have to drive long distances. It's just not going to work. The range today is not going to work for a lot of commercial customers. The charging experience persists as a critical friction point, with industry analysis confirming that, One of the challenges to EV adoption is charging. It's complicated for people. You have to know the difference between L2 and L3 charging. These technical hurdles give automotive executives legitimate reasons to question whether mass adoption is truly achievable in the near term. The rental market has provided another troubling signal that privately reinforces doubts. Hertz's February decision to offload 20,000 EVs from its fleet at substantial losses sent ripples through the industry, reinforcing perceptions of a market correction in progress. This high-profile retreat from electrification may reinforce private doubts among automakers about whether market demand will materialize at the pace and scale necessary to justify massive investments. When Volkswagen dealers in some regions began returning unsold electric vehicles to the manufacturer last quarter, it highlighted the disconnect between production plans and consumer demand, a gap that creates legitimate business concerns rather than ideological resistance. The regulatory landscape in 2025 has injected new variables into strategic planning, creating additional uncertainty that feeds automaker ambivalence. The Trump administration's rollback of certain EV incentives has shifted market dynamics, with the observation that Trump is trying to reverse EV trends, not just abandon them. While the federal tax credit of up to $7,500 remains available for many battery electric vehicles, tightened requirements on battery material sourcing that took effect this year have reduced the number of eligible models. The ZEV mandate that requires automakers to sell increasing percentages of zero-emission vehicles places immense pressure on manufacturers, with potential fines of $15,000 per car for those failing to meet targets. This regulatory whipsaw creates legitimate hedging behaviors that can appear as foot-dragging, but reflect genuine strategic uncertainty. Meanwhile, China has reached a historic milestone that creates competitive anxiety for Western manufacturers. For the first time, electric vehicle sales are predicted to outpace internal combustion engine vehicles in the world's largest automotive market, with BYD delivering an astonishing 4.27 million EVs and plug-in hybrids last year. Bloomberg NEF forecasts that 65% of all EVs sold globally this year will be in China, underscoring the country's dominance in the electric transition. This competitive pressure creates a complex dynamic where traditional Western automakers must balance the need to compete in this new landscape against the financial pain of rapid transition. Europe presents yet another distinct narrative that further complicates global automaker strategies. The EU market began 2025 with 21% growth, selling over 250,000 EVs in January, as manufacturers scrambled to meet new emissions targets that took effect this year. Under the Fit for 55 roadmap, European automakers must achieve a 15% reduction in CO2 emissions between 2025 and 2029, driving a strategic pivot toward more affordable models. Several European manufacturers, including Citroën, Fiat, and Renault, are launching EVs priced around $20,000, $21,000 this year, less than half the $46,000 average EV price seen in 2023. This creates a global strategic puzzle for manufacturers, trying to optimize resources across divergent regional requirements. The workforce implications of EV transition add another dimension to private reservations. Electric vehicles simply require fewer parts and less labor to assemble than their combustion counterparts, approximately 30% fewer workers according to industry estimates. Across America's automotive manufacturing regions, electrification brings profound anxiety about job security. The UAW's contracts secured in late 2023 provide some protections, but executives recognize the long-term implications for communities built around automotive manufacturing. This creates another incentive for some leaders to privately hope for a more gradual transition that would allow workforce adjustments to occur through natural attrition rather than layoffs. The affordability gap remains substantial in 2025, despite years of predictions about price parity. The average new EV sold in America last month cost $51,320, compared to $46,380 for internal combustion vehicles, a gap that widens for comparable models once tax incentives are removed. This persistent premium limits market penetration primarily to upper-income demographics, creating legitimate concerns about whether mass adoption can occur without significant further price reductions. For automakers accustomed to serving broad consumer segments, this creates uncertainty about the timeline for true mainstream adoption. America's electrical grid adds another layer of complexity to automaker calculations in 2025. In Texas and California, where grid reliability has become a political flashpoint following high-profile outages in January, the prospect of adding millions of power-hungry vehicles to already strained systems creates legitimate concerns about infrastructure readiness. Consumer confidence in electricity-dependent transportation inevitably suffers when blackouts make national news, reinforcing private doubts about rapid transition timelines. For automotive executives responsible for product planning 5 to 7 years into the future, these infrastructure uncertainties create legitimate reasons for caution. For consumers willing to overcome adoption barriers, 2025 has become the year of unprecedented EV deals. The market is flooded with options across price points, with particularly aggressive discounting on models that lost tax credit eligibility. Dealers are increasingly offering 0% financing to move inventory, creating a buyer's market that contrasts sharply with the seller's advantage that dominated during the pandemic years. This pricing pressure further strains already challenged EV profit margins, reinforcing private hopes for a more gradual transition that would allow for sustainable economics. As 2025 unfolds, the electric vehicle transition continues, though not along the linear path many predicted just a few years ago. The reality is messier, with regional divergences, policy-driven market distortions, and evolving consumer preferences, creating a patchwork of adoption rates and manufacturer strategies. Behind closed boardroom doors, the complex mixture of financial incentives, strategic investments, technical limitations, market uncertainties, regulatory whiplash, and competitive pressures creates an environment where some automotive executives might privately welcome a more gradual transition, even while publicly embracing an electric future. This isn't simply resistance to change or conspiracy with oil companies, as some EV advocates might suggest, but reflects genuine strategic dilemmas that traditional automakers face as they navigate what may be the most significant transformation in automotive history. The transition requires not just new technology, but new business models, new supply chains, new workforce skills, and new consumer education, all while maintaining profitable operations to fund these massive changes. When automotive executives privately express hope for a more measured pace of change, they aren't necessarily opposing progress, but acknowledging the complex realities of transforming a century-old industry that employs millions and serves billions worldwide. The industry will ultimately transform. The only question is whether the timeline matches the ambitious regulatory schedules or follows a more evolutionary path that allows for adaptation rather than disruption.